for the morning. Dipen, Head Institutional Research at HDFC Securities, joins us now. Morning, Dipen. Good to have you with us, as always. Do you think Fed is going to be a non-event, fully chewed, discounted, digested, that if the hike really comes, it will be business as usual on Thursday morning?
Yeah, so I don't know how long we've been chewing this cud, so to say. And for me, I think it's not just the hike of 25 bips, which I guess is all but on the table. But what's the commentary going to be like in terms of further hikes, and how is that sequencing going to be done? And if they maintain that they're going to be data sensitive, which they will, that's the stance. So a lot of the data is mixed out there, and I don't think we can take step hikes for another 6-7 meetings just like that, just because they raise it by 25 bips. Here we are near zero now, so this is just a realignment in direction, but I don't think that direction is very well established. So this is really a non-event. I would completely agree with Udayan, what he was saying a few minutes ago on your channel.
Okay, so let's talk about some of the stocks and sectors that are moving the pain. Everyone's talking, wondering how much more the banks are going to correct, how some of these private banks have completely fallen from grace in the last couple of months. Do you, sort of catch the falling knife, or do you just stay away from these private banks? So
it's an iffy situation. The fundamentals are definitely, the news flow which is coming in has been very bad for the smaller PSU banks, has been bad for the larger PSU banks, and maybe a little less than bad for the large private sector banks. So I guess you are specifically referring to Axis and ICICI, yes, where a lot of value destruction has certainly taken place. If you just pull out the charts over the last 3 months or something, and you will see what's happened. So the fear is common across the board, except that it reflects much stronger in the valuations of the smaller PSU banks. But here too, I think the larger sense is that the private sector banks may not see as much damage in terms of incremental.
No, but do you buy them now, or do you not?
I think they're I think they're all in the buy zone, whether it's Axis, whether it's ICICI, and it's not a conviction buy zone, because right now the headline news flow which comes through every week from the RBI at least. So at least the errant borrowers, so the naughty kids in school are going to be punished by the principal, and who suffers? The class teacher. So. So a little bit of that will play out with Axis and ICICI, but I think, to my mind, there is no doubt, particularly on Axis, I will say this with emphasis, that the quality of lending should simply not be compared with the kind of quality of lending that we've seen at some of the smaller PSU banks. It's reflected only partly in their valuations, and this valuation divergence which has narrowed should actually expand as you move forward, and many of these problems do get resolved. The worry is that the economy is sluggish, and a whole lot of places where you have stress formation are not corporates who are going to get cured overnight. So yes, I think you have to get out and catch these falling knives somewhere. At least they have capability, franchise, capital, and large fat networks.
Yes, as well. That hasn't sold off much.
It hasn't sold off much. We don't have coverage on yes.
Okay.
So I will hesitate from making a definite comment there.
Okay, let's talk about some stocks that you have coverage on. You have been talking about Majesco and the up move for a very long time now, but that stock has actually come off from its highs.
Right.
In fact, it had hit a high of 700 and now trading at somewhere around 580. You think it's a good time to be buying Majesco?
From a long-term investing perspective, even 700 may not have been a bad time to buy. So here is the irony, okay? And you have to look at it in the context of where markets have gone broadly over the last, trailing year or so. So let's zoom back to a year ago, and ironically, slots like this are called Market Mster slots, and I will completely reject this allegation, at least for myself. So how many of your Market Masters said that you would get negative returns over 2015? So we all fall into the trap, and let's be humble here. We all fall into the trap of looking at the last 12 months and saying what the next 12 months are going to be like. So the last 12 months in January 2015 were the sexiest that we had seen in a decade. Okay, so it was very tempting to say, okay, so now this is India's decade, and I'm offering no defense. I was part of that pack. Okay, and here we are sitting on 7.5% negative YTD returns on the Nifty, 15% from the March peak, if memory serves me right. And you're talking about Majesco. So this is the thing. In a market that has gone nowhere, the only way you will make money is not by looking at how people have been doing in the last 12 months, but what they're going to do in the next 12, 24 and 36 months. And in Majesco's case, it's very clear that they are in a software product niche, which has got very low penetration and which the product itself is very highly rated by market analysts and experts in the US. This is a sliced out entity from the erstwhile, United or whatever, Mastec. And they had an insurance, property and casualty insurance product. Which they sliced out into a separate company. And now this is a debt-free, pure play $100 million revenue run rate company with complete non-linearity in a $9 billion addressable opportunity market. So does it mean that you will make positive returns over the next 1 year? You can argue about that, because right now you don't see that revenue traction or that non-linearity play out. The minute you see it, are you going to chase the price? So if you're a patient investor, you want to hold for 2, 3, 5 years and maybe triple your money. We have a thesis which we published in the form of an initiating coverage report, and the entire story is laid threadbare and what we feel can happen over the next 4 or 5 years in this company.
Okay, and what kind of revenue growth are you looking at? Or price targets?
Let's not hazard a revenue growth and a price target. All I'm telling you is that this is a $100 million company which is highly rated for its product, which has made acquisitions in a way which will add to the quality and the capability of that product and take it beyond just being, an insurance ERP, so to say, well into the domain of analytics, digital and, cloud. And in a market where, so the insurance companies have been the last guys off the block in outsourcing, let alone offshoring. Okay,
yeah.
And insurance is a huge industry in any country, more so in the United States, and they are just biting around the edges. And if they get this game right, they could be up 3x in revenues over the next 5 years.
Okay.
I'm not playing this for 5 months. I'm certainly going to play
this
this
is a
for 5
long-term
years.
story.
Absolutely.
The other one that you've picked up is, as we've been saying, the action is all outside the index. And in the cement space, you've picked up Sanghi Industries. It's had a great run this year. It's up 25% in a market like this. Do you see more value there?
So a year ago, a year and more ago, I think a year and a half ago, when we invited Sanghi to one of our investor meets, they were trading in the mid-20s and nobody wanted to believe them because they had stumbled badly more than once in life. They were a debt restructuring case and, they had gone through severe stress in terms of profitability. In fact, commissioning their plant and then profitability and project cost overruns, time overruns, and then, of course, got into the bad end of the cycle and so on. Now, what struck us at that point of time, and this is a story I've been repeating n number of times on our channel, was that here was a company which had kind of picked up the pieces and was steadily repaying debt and bringing down debt on its books continuously for the last 2 or 3 trailing years. Okay. And despite the fluctuations, so cement is a cyclical commodity, and if you have high debt on your books and you get caught on the wrong end of the cycle, you can go under. So the more it was repaying its debt, it was becoming stronger as a company to withstand downturns. That is one part. 2, it was running a 2.5 million ton capacity while sitting on 1 billion tons of reserves, limestone reserves. So here was a company which was paying back debt, and in the next phase, it would certainly be able to expand capacities, and they've done that. They've added 1 million something recently. I think this can become a continuous compounder. If you will go back to the early 90s and look at Shree, and I hate to draw comparisons, but this is exactly the size of company and the size of opportunity that Shree was looking at in the early 90s or mid 90s. Okay. And we all know where Shree has reached. So again, it's not about 25 to 60. Is it a good move for Sanghi? I think the opportunity is, can they grow from 2.5 million tons to, let's say, 10, 12, 15 million tons over the next decade? Okay. Again, a very, very long-term story to stay invested in, simply because of the addressable opportunity and now the much better financial health that you can see on their balance sheet.
Okay, KPIT is the one that will intrigue a lot of
Yes.
investors, because a couple of quarters the company did disappoint. What do you like in that company?
So here was a company, here was a tech company which went through stress as a couple of large accounts went sour in one of the verticals. And to our mind, KPIT was a below average IT company run by very sincere and honest professionals. And they were kind of getting it right for a while, and then they stumbled. And everybody began to point fingers at them and say and saying that, look, we told you this is a substandard company. And I went and met them. And there was nothing which hit my gut saying that they were bad people, bad people in the sense that can they ever create wealth for investors. They had very high pedigree in terms of their older associations with Cummins, for example, and a very decently performing software business. So there are 2 or 3 verticals, and like I said, one of those verticals had stumbled in one of the quarters or 2 quarters. And sure, they were not as shining a company as, let's say, an Infosys or a TechM or you name it, an HCL Tech or a Wipro or what have you, or a TCS, definitely. So they were much smaller, and they were in a league where their structure, their working structure afforded them lower margins. But even so, even adjusting for those lower margins and the one-off on the crack in one of the verticals in their business, they were trading at less than revenues. I mean, I said this can't get any cheaper. So if you believe that these guys aren't crooked, then this is the time to buy. And it's up some 70% from there. Now, will you again go up another 70% in a year? I don't know. I doubt that I will. But to my mind, the time to buy what you think is a good stock is when nobody wants to believe that story. So I would extend and extrapolate that for the country as well.
And finally,
so our markets have gone nowhere for a while.
But then how would you justify a buy on Naveen Fluorine? Because that story is well discovered,
and
well owned,
and
it's gone up almost 200% this year.
Yeah. So on Naveen, I think the valuations are indeed, so we have a target price of something like 1800 or something, if I remember, and they are at about 17-ish.
Yeah.
They went up to about 1900 recently in the recent excitement after their quarterly numbers got announced. Now, for me, what is important in the case of Naveen is that 1 year out, 2 years out, they are going to be having a completely different product mix from where they stand right now. And that product mix is something that very few companies in the world can achieve or replicate. So in any case, fluorine-based companies are, not dime a dozen, let me put it that way. Just a handful of companies globally are involved in fluorine chemistry. It's a very difficult to master technology. It's a very hazardous set of chemicals. I don't know if you're aware, but hydrofluoric acid can just dissolve glass like a knife can cut through butter. Okay, so that and the fact that a whole lot of downstream chemicals from fluorine chemistry are increasingly being adopted and used in pharmaceuticals with tremendous efficacy is what made us bullish on them. Now, I don't know the mumbo jumbo of what exactly they're going to make, but with every progressing quarter, you can see it reflected in their margins. And I think a lot of their new capacities are yet to be commissioned and deliver.
Okay. Well, that's a bunch of stocks you've spoken to us about, Dipen. Thank you very much for joining us and also for telling us that on Thursday it won't be a very big day for Indian markets, especially if the Fed were to...
And again, if you will allow me to make this point here, Lata, looking back at the last 12 months and getting disappointed is the standard trap that most of us market men get into. And I think this is the time to... So 12 months ago, a very close friend of mine told me, and I thought he was daft. He said, you guys are all excited. And I think maybe 2015 won't give us positive returns. I laughed at him. I think he's having the last laugh now.
Oh, absolutely.
Okay, well, you think that being called a market master is an allegation, but no, it is a compliment. So we'll leave it at that. Thanks, Dipen, for joining us. With that, it's a wrap on Bazaar Chat.